mean, what about what Jamie Dimon said in the annual letter yesterday, right? He wrote in the annual letter that the current crisis is not over yet, and it is, even when it is behind, there will be repercussions from it for years to come. I mean, this morning, the UBS chairman is speaking at the company's annual general meeting, saying that the UBS Credit Suisse integration will take up to 4 years, Mario. Your thoughts on what we're hearing as this market, 135? 145 is the number on ADP. It is crossing right now 145,000 jobs created in the month of March. That is below expectations, Mario. The estimate was 200 to 210,000, but we got 145,000 jobs. Market is digesting this. We're flat right now. How do you read this report?
Like I said, there's holes in the boat, and the boat's starting to go down. So going back to what Jamie Dimon said, Maria, Jamie Dimon's a very smart man. And if you didn't have the FDIC, the Treasury, and the Fed Department save SVB, right, and then as well as Signature Bank, I think things would be a lot worse. It's like an EMT. You see a junkie on the side of the road, you give them Narcan to bring them back to life. Well, we just used 3 pens. How many more pens do we have for the rest of the banks? I think there's going to be a little bit more cracks. You see the futures going down a little bit more. They were relatively flat or slightly green this morning. Yeah. I think we could have a little bit more volatility ahead.
The expectation has been, James, that we are going to see this employment story weaken as growth weakens.
Yeah, and we've been trying to figure out, we saw the February JOLTS number, 9.9 million jobs. Not as great as the 12 that had hit a record last spring, but still pretty great historically. Almost 4 million above the number of people looking for work. So still seems like, even if not as good, a very good jobs environment.
You know, the jobs environment, they missed by about 5%. They thought they were going to come in at 10.4. They came in at 9.9. So we're starting to see a trend slowly, back up. We were, the jobs was at 80 miles an hour. Now we're dialing it back, and we're at 50 miles an hour, 56-year lows. But first comes the economy with the cracks, and then it's going to bleed into the jobs market. You have every tech company from New York to L.A. to, Little Rock, Arkansas laying off employees, and it's just going to be a matter of time before.
I did want to quarrel with your Silicon Valley Bank example. That was a group of people that really was ready to take losses, would have taken modest losses, and the world would have gone on, don't you think? Or you think that would have triggered some kind of great crisis?
No, I think it'd be foolish to say that it's a one-off example, right? Look at the smaller regional banks. There was a great article in Barron's this past weekend with CRE. That could be the next shoe to drop with all these commercial loans. We're here in New York right now. Look how many vacant buildings there are when it comes to commercial real estate.
I've been worried about commercial real estate, but so far we haven't really seen significant cracks. But you're right, it's an issue to look at.
Yeah, well, we got that amazing statistic, I thought, from the earlier report with Jeff Flock showing 30% vacancy retail rates in the prime shopping district of Chicago. But notwithstanding this number that just popped, the 145K.
And February revised actually showing 261,000 versus
okay. Which is actually higher, and that's a little bit, that softens the blow a little bit.
Yes, but I mean, how do you reconcile the difference between the perceived strength of the jobs market and consumer confidence with the talk of the recession?
Yeah, so I think jobs is an important component at the end of the day. It is. However, I think at the end of the day, it's a lagging indicator. You can just go to the grocery store, go to a commercial building, go to a retail building. My headquarters is in a larger building in Long Island. We have multiple floors starting to become vacant. So I think you have to see what's going on, and you have to have a little clairvoyance and a sixth sense of where we're going to go. So I think it would just be foolhardy to say, hey, it's rainbows and butterflies right now. You have the third biggest bailout that just happened 2 weeks ago. And if they didn't step in, it would be a lot worse. So I think at the end of the day, I think between a strong jobs market right now is the only life raft on a sinking ship. So.
Well, Mario, if I may, given how concerned you sound about the economy, banks, et cetera, how much cash have you raised for your investors so that they stay clear of this?
Absolutely. So I think the best trade on Wall Street when I was here 2 months ago, Treasury bonds, right? 5.25%. Equity risk premium was at a decade low. It was free money. You go out 12 months, you get 5.25%. Oh, and no state income tax free. However, what had just happened in the fixed income market, and this is why the stock stock market.
Yields.
Yeah, yields just retraced 20%. You had a 2-year Treasury on March 8th. Yielding you 5.1%. Now it's yielding you approximately
3.5.
Just under 4%, 3.8. So that's a major catalyst. And there was an old adage. It went Tina, and I'm not talking my ex-girlfriend either. There was no alternatives. And then it went to Tita. Treasury is the alternative. Now we're starting to shift back, so it's a little bit of a seesaw. But I think at the end of the day, being in fundamentally sound companies, paying dividends and raising dividends are the right areas to be in. But I do like Treasuries right now. I do like some risk-free alternatives.
Mario, thank you.
You
Great
got
to
it.
see you. Mario Veneroso here.